The global financial cycle is shifting, creating a massive upcoming wealth redistribution. And to understand the magnitude of what this means, you must recognize that every major economic transformation in history has followed a recognizable pattern. Cycles expand, contract, peak, and reset. And while the timing may vary, the underlying forces remain consistent. Today, those forces are aligning in a way that signals one of the most significant transitions of our era. Debt levels are reaching unsustainable heights across major economies, currencies are being quietly reevaluated, geopolitical tensions are redrawing trade routes, and technological breakthroughs are reshaping productivity far faster than traditional institutions can adapt. These are not isolated events. They are interconnected shifts that influence each other like gears in a giant machine. When these gears begin to rotate in a new direction, the entire financial landscape transforms with them. At the core of this shift is the reality that wealth is never destroyed. It simply moves. It moves from those who remain static to those who adapt. It moves from those trapped in old systems to those who recognize new ones forming. Right now, the movement is accelerating, and it is happening on multiple levels at once. In the monetary system, inflationary pressures, central bank policies, and global trust in traditional currencies are converging into a point where new forms of value storage are emerging. In the investment world, the dominance of passive strategies is being challenged by volatility, liquidity imbalances, and a new environment where the old assumptions about safe assets no longer hold. In technology, automation, artificial intelligence, and digital platforms are creating leverage that enables a single individual to produce the output of an entire team from decades ago. These changes don't just add new wealth, they shift the entire distribution of who controls it. The people who do not see this shift unfolding are the ones most likely to be caught off guard. They believe the next decade will resemble the previous one because familiarity feels safe. But cycles never repeat exactly the same way. They rhyme, they echo, and they produce patterns that reward those who observe them early. A financial system under strain behaves differently than one in expansion. A global order in negotiation behaves differently than one in stability, and markets driven by innovation behave differently than markets driven by tradition. These differences determine who rises and who falls in the wealth distribution curve, and they create opportunities that are invisible to those who only look at the surface. If you look closely, the signals are everywhere. Asset bubbles inflating in some sectors while others quietly reset. Governments recalibrating their fiscal priorities. Investors shifting from complacency to caution. Corporations restructuring their entire models to incorporate automation and digital ecosystems. Each of these movements is like a tremor occurring before a major seismic shift. Individually, they might seem manageable. Together, they indicate a structural turning point. When the financial cycle reaches this kind of inflection moment, wealth doesn't just shift modestly, it accelerates toward those who read the currents correctly. Understanding the magnitude of this redistribution requires recognizing the silent yet powerful role of incentives. As governments respond to rising debt, as central banks defend currency credibility, as businesses chase efficiency, and as individuals search for stability in uncertain times, behaviors shift. These shifts create new winners and losers almost overnight. The investors who thrive are the ones who follow the incentives, not the narratives. The entrepreneurs who succeed are the ones who spot inefficiencies created by the transition. The everyday individuals who elevate their financial position are the ones who educate themselves, adjust early, and refuse to remain anchored to a previous economic reality. A financial cycle turning is not a theoretical concept. It is a lived experience, and it rewards those who recognize its direction before the majority does. Preparation and understanding economic patterns are essential to avoid being swept away, because in moments of major transition, the gap between those who anticipate change and those who react to it becomes wider than ever. Most people move through financial life influenced by emotions, headlines, and surface-level trends without recognizing the deeper forces shaping the world around them. They focus on the immediate pressures rather than the underlying mechanics, and as a result, they are often blindsided when the cycle turns. Preparation begins with the ability to step back and look at the broader landscape, to identify the signals that precede major shifts, and to interpret them without falling into fear or complacency. In the same way a sailor studies wind patterns before launching into open waters, individuals must study the economic winds that determine the direction of markets, productivity, and global stability. Understanding patterns means recognizing that nothing in the economy moves in a straight line. Growth phases eventually peak, and peak conditions eventually cool. Excess always leads to correction. Fear always leads to opportunity. These are not surprises. They are natural parts of a system that has repeated for centuries. The people who thrive financially are the ones who internalize this rhythm and prepare for transitions before they become obvious. Preparation is not guessing. It is observing cause and effect, understanding how policy decisions ripple through the economy, and identifying how debt cycles, productivity shifts, and human behavior overlap to create predictable outcomes. When you can see the structure beneath the noise, you stop responding in panic and start responding with clarity. Most individuals wait until the storm is already upon them before they take action. By the time they realize a cycle has shifted, options become limited, choices become constrained, and emotions cloud decision-making. Preparation flips that dynamic entirely. It allows you to act while others hesitate and adapt while others deny reality. It means building cushions during good times, knowing they will be needed later. It means learning to diversify instead of chasing what seems popular. It means understanding that the economy does not reward those who simply work hard, but those who work intelligently based on the environment they are in. Preparation is a strategic advantage, not a luxury. The importance of understanding economic patterns becomes even more critical during times of accelerated change. Technology amplifies the speed at which markets move and the pace at which information spreads. Geopolitical decisions that once took years to influence markets now have immediate impact. Monetary policy announcements can shift trillions of dollars in minutes. In such an environment, relying on instinct or outdated assumptions is a recipe for vulnerability. What once took a decade to unfold can now happen within a single year or even a few months. Preparation requires a mindset that is constantly updating, learning, and adjusting as new data appears. It requires developing the habit of questioning, analyzing, and thinking independently rather than following the crowd. Those who prepare position themselves on solid ground while others sink into uncertainty. They recognize that resilience is built long before it is required. They understand that opportunities appear most clearly to those who have already done the groundwork to recognize them. Preparation turns chaos into clarity, confusion into strategy, and uncertainty into advantage. It allows individuals to navigate volatile environments with a level of confidence that comes only from understanding the deeper forces at play. When you understand economic patterns, you begin to see events not as isolated surprises, but as natural outcomes of a system that is always balancing itself. The financial world stops feeling unpredictable and starts feeling navigable, because you are no longer reacting to the surface, you are reading the structure beneath it. Technological disruption is accelerating, making outdated thinking dangerous, because the speed at which innovation transforms industries has surpassed anything previous generations have experienced. What once unfolded over decades now occurs within a few short years, and in some cases, within months. Entire business models can become irrelevant almost overnight as automation, artificial intelligence, digital platforms, and decentralized systems reshape how value is created, exchanged, and scaled. People often underestimate the true magnitude of these changes because they are accustomed to linear progress. Yet technology advances exponentially. This means society is repeatedly caught off guard, realizing too late that the ground beneath them has already shifted. The individuals who cling to old methods, old assumptions, and old structures find themselves competing in a world that no longer exists, while those who adapt early position themselves at the forefront of the new economic landscape. One of the most transformative aspects of modern technological disruption is the unprecedented level of leverage it provides. A single person can now build a business, manage global clients, automate operations, and scale faster than entire teams were capable of doing in the past. Algorithms handle tasks that once required specialized labor. Artificial intelligence can analyze data at a scale no human could match. Digital ecosystems allow entrepreneurs to reach worldwide audiences instantly. This level of leverage fundamentally changes who wins economically, because the advantages once reserved for large corporations and wealthy institutions are now available to individuals who understand how to use the tools in front of them. The gap between those who embrace this leverage and those who ignore it becomes a divide that determines financial outcomes for decades. Technological disruption also changes the nature of job security. Traditional roles that provided stability for generations are being phased out or restructured. The skills that once guaranteed a solid career are no longer sufficient in a landscape where automation replaces repetitive tasks and data-driven systems make decisions faster than human teams. This does not mean opportunity is shrinking. In fact, opportunity is expanding rapidly. But the types of skills that create value are shifting. Adaptability, digital fluency, problem solving, creativity, and strategic thinking are becoming the new foundations of long-term success. Those who continue relying solely on yesterday's skills find themselves increasingly vulnerable, while those who invest in learning newer, more scalable skills position themselves to prosper in the new economy. Outdated thinking becomes especially dangerous because it blinds people to the opportunities hidden within disruption. When someone believes the old way is the only way, they fail to see the emerging pathways that could elevate their financial position. They may dismiss digital platforms as fads, underestimate the importance of data literacy, or avoid new technologies out of discomfort or fear. In doing so, they unintentionally lock themselves out of the most powerful wealth-creating mechanisms available today. Meanwhile, individuals who stay curious, who experiment, who learn continuously, and who embrace unfamiliar tools develop an instinct for spotting the next wave before it becomes mainstream. This instinct becomes one of the greatest competitive advantages of the modern era. Even finance itself is shifting under the weight of technological advancement. Markets react faster, liquidity moves across borders with unprecedented speed, and pricing models adapt instantly as algorithms process massive information flows. The very structure of investing has changed, rewarding those who understand how technology influences volatility, asset pricing, and long-term value. The intersection of technology and finance becomes a landscape where wealth is both created and reshaped, and where those who remain rigid or uninformed face greater risk. At the same time, individuals willing to understand how the digital world interacts with the economic world find themselves in a position to capitalize on new opportunities that were previously unimaginable. The acceleration of technological disruption requires a mindset grounded in agility, continuous learning, and strategic awareness. It demands a willingness to let go of outdated beliefs, outdated habits, and outdated fears. The world is not slowing down, it is speeding up, and those who keep pace will be the ones who rise as this new era unfolds. Success requires building mental, strategic, and financial resilience, because in times of rapid change and uncertainty, strength is not determined by who has the most resources, but by who can withstand shocks, adapt quickly, and continue moving forward while others are paralyzed. Resilience is the internal and external armor that protects you from the volatility of the world, and it is built long before it is needed. Most people think resilience is something you tap into during a crisis, But true resilience is built quietly, intentionally, and consistently during periods of stability. It begins with the mind, because your decisions follow your thinking. When the world shifts, fear and confusion can cloud judgment, leading to impulsive reactions, emotional decision-making, and missed opportunities. Mental resilience gives you the ability to stay calm when others are panicking, to see clearly when others are blinded by anxiety, and to make strategic choices based on principles rather than emotions. Mental resilience comes from understanding how the world works and accepting reality rather than resisting it. It is built through habits like reflection, learning, and questioning your own assumptions. When you practice looking at situations objectively, you remove the emotional distortion that often leads people to make poor financial decisions. You learn to separate the noise from the signal and to focus on the deeper forces shaping outcomes. This kind of resilience allows you to stay grounded during uncertainty because you trust your ability to think independently, analyze risk accurately, and respond rationally. When others freeze or retreat, mental resilience pushes you to stay proactive, disciplined, and forward-focused. Strategic resilience is the next layer, and it is about creating structures, systems, and frameworks that allow you to adjust quickly to new realities. If mental resilience is the internal compass, strategic resilience is the map you follow. It is built by asking the right questions. What risks am I exposed to? What assumptions are guiding my actions? What changes in the environment would make my current approach obsolete? People who lack strategic resilience cling to a single plan, a single career path, a single income stream, or a single investment strategy. When the world shifts, which it always does, they find themselves trapped with no alternatives. Strategic resilience means having contingency plans, diversified income possibilities, flexible skills, and the ability to move in a new direction without losing momentum. It means you can pivot quickly without breaking. Financial resilience is the external foundation that supports both your mental and strategic strength. It is not about simply accumulating wealth, but managing it intelligently. It is built through principles like diversification, savings, discipline, careful risk management, and long-term thinking. Financial resilience gives you options, and options are power. They allow you to take advantage of opportunities that others cannot afford to pursue. They give you the ability to withstand downturns without losing everything you've built. They protect you from making desperate decisions when times get difficult. When you have financial resilience, you operate from a position of stability instead of survival, and this dramatically increases your ability to navigate uncertainty with confidence. A person who is mentally resilient but financially fragile is still vulnerable. A person who is financially strong but mentally unprepared can easily make catastrophic mistakes during stressful periods. A person who is strategic but lacks emotional control may overreact to volatility or hesitate when decisive action is needed. True success in this era requires all three forms of resilience to work together as one system. They reinforce each other, they strengthen each other, and they create a level of stability that cannot be achieved through money alone or mindset alone. As the world moves into a period of accelerated transformation, those who invest in building these layers of resilience will find themselves capable of not only surviving whatever comes next, but thriving through it. Resilience becomes the competitive advantage that separates those who rise from those who are overwhelmed. Principles, diversification, discipline, long-term thinking outperform emotional decisions because the financial world is shaped far more by human behavior than by market conditions. Markets move in cycles, but people often move in patterns of fear, greed, impatience, and overconfidence that leave them vulnerable at the worst possible times. Principles serve as the stabilizing force that keeps an individual anchored when emotions tempt them to make reactive choices. Diversification protects against uncertainty by acknowledging that no one can predict the future with perfect accuracy. Discipline ensures consistency, even during moments when the environment feels chaotic. Long-term thinking shifts focus from temporary fluctuations to sustainable growth. Together, these principles create a framework that is stronger than any single strategy, trend, or prediction. Diversification begins with humility, the recognition that no matter how confident you feel about an investment, an idea, or an economic outlook, you can still be wrong. The world is too complex, too interconnected, and